There was nothing on the market good enough, punchy enough to get my consultants billing quickly in tough markets. Nothing that engaged my consultants, keeping them hungry for deals. Nothing that kept them sharp. See, no one was as good at training my people as I was. But this took a lot of my time. What was available for my senior consultants? How could I maximize their revenue? There was nothing on the market that truly made my people feel invested in, that I would be comfortable putting them in front of. So we made it. Find out why people are joining the RecWire Plus recruitment platform. Link in the show notes. Back to the show.
Welcome to the Recruiter Startup Podcast. I'm joined today by Logan Naidu from Kernel Global. Logan's been on the podcast before during lockdown.
Yeah.
We're not allowed to talk about lockdown. Not on a Friday. Not on a Friday when the market's up again. Good times are ahead of us. It's
you can say that in the first week of the year, can't you?
Big time. First week of the year. Let's go get it done. Just for anybody who doesn't know you, Logan, tell us a little bit about your business.
So I've been in recruitment now for 20 years, founder of two businesses, first one in 2005 and more recently 2012 Dartmouth Partners, which has been through two P transactions. So Dartmouth went through their first P transaction in 2018 when it was just one business. Kernel was founded when we acquired a business called Pure Search in 2019. And today we are 4 brands under the Kernel umbrella, 200 heads, 4 geographies, doing roughly £10 million profit.
Lovely. Right. Okay. So we're going to make the most of you today. We are going to find out a bit more about the PE world in recruitment. We're going to figure out what the difference is between having a first deal done, what happens then on a second deal, and then just advice that you can give to other founders who are thinking about that along the way, and how you see the entire market play out. Because, you know, a lot of us, we set up companies and we think maybe one day we might sell it. We don't know how to get there. Then when we get there, the market turns and we miss the chance, or we haven't managed some element correct, or we've got the wrong advice, or we've just made a wrong step along the way. Now, I'm sure you haven't made all good decisions throughout your 20 years, but I'm sure that you've been able to learn from each and every one along the way to get to this point. So we're going to try and disseminate all the good stuff today. So I suppose for anybody listening, can you tell us what private equity is and what that means to the recruitment sector? How do companies go from a foundation to getting an event?
Sure. Okay. I think, look, lots of questions there. I guess the starting point, Dualta, is probably, when you set up a company, I think everyone sets it up largely in our sector because the premise usually is I make £1 and I get paid 30 to 40p and I want to own £1. And they kind of think, actually, what happens to that 60p the boss must be taking that and hitting the bottom line. And so generally, I'm not saying this is with everyone, but generally the level of financial sophistication which recruiters generally set their business up, it's usually the premise of a great salesperson who's willing to back themselves, saying that I want to own the whole pound. And there usually, not always, but usually isn't a business plan around how do I get to exit, or not even a thought process around what am I going to do with this business. It's just generally I want to own more of that pound. And I think that, when we talk about 36,000 recruitment companies in the UK, the majority are obviously sub 10 people. You know that better than I do. And the majority have been set up because they want to own more of the pound that they generate. So there is really no view on an exit. Maybe there's a dream one day we'll sell this business because it will be worth a lot. But the level of thoughtfulness and sophistication into business planning around how do we achieve an exit is relatively low because they're being set up by good salespeople, hopefully. And so my starting point for a lot of people is to work out why are you setting up the business properly and what is your plan here. And thankfully, I think the industry's changed a lot in the last 10, 15 years. There's generally a lot better advice. People are a lot happy to share that advice and help others. and it's become a slightly less zero-sum game in the sense that for us to win, someone else has to lose. I think we take the view that we've had quite a lot of help along the way, and we're happy to share that, because whilst we can duke it out on the market, you can still have a beer and be friends off the pitch. And
Why
so
is that? Why is that, do you think? Because it is true. Like, people are very open to sharing, and I know there's a bit of a one-upmanship to who can share the better information, like, and but what is it about our industry that makes information so free flowing and not confidential?
I think we've grown up a bit, maybe in the last 20 years. I don't know. I mean, the world's changed, right? The culture's changed a little bit. Maybe the industry's become a little bit softer and a little bit kinder
Yeah.
along the way. Or maybe when all the people that are now running businesses, I guess holistically we've generally become slightly more rounded individuals. Maybe. I mean, the kind of lunacy that exists in the industry still exists, doesn't it? A little bit, but it's been dialed down a little bit than compared to how it was.
Who buys recruitment firms?
Mad people. No, I think look,
Okay.
the the industry, if you take, what's your exit likely to be? You've got three forms of exit broadly, right? Which is, one is institutional investments, so private equity of some sort. Two, or an IPO, which is obviously increasingly rare. Two is a trade sale to a bigger firm, and three is a management buyout. Those
Okay.
those are your three options.
Can we focus in on one just to start?
I mean, look, private equity is where you started with, right? And that's traditionally for the more sophisticated, faster growing businesses where, you're not running it for cash flow, you've got a growth story. And so, private equity at the moment in the UK and the US, it's been a tougher market, but both in deployment in terms of getting money out the door. So they're sitting on a wall of cash. The thing that stopped larger buyers happening has been that the kind of credit market and the leverage available has not been as loose, and with interest rates, being priced at 8, 9, 10%, it's quite hard to. There's no cheap debt, right? So they have to put more equity in, and then cyclically, our sector benefited from the boom as much as anyone in 21 and 22. And I think what we've seen in 23 and 24 is the tide go out pretty quickly, and a lot of people feel a lot of pain for longer than they thought it would last. And if you listen to Radio 4, when was it? Yesterday morning, you had Toby Felson on Radio 4 at 6 o'clock, kind of talking down the prospects of the recruit market for the next 6 months. So, I think that, that will make private equity cautious around the sector, because they need some visibility of stability and growth to kind of want to deploy money into the sector.
All right. So I'm a recruiter, set up my own company. I've got a load of hungry young guns in here. We're making good money. Looks like I could hire another 20, 30, 40. Things are going well. I've caught a wave. Um, who are these private equity companies? How do I get in touch with them? And what are they going to ask me?
Look, private equity, I mean, all it is a pool of capital, right? So it's a pool of capital, whether it's one guy with 10, 20, 30 million quid. And there are some, there's a couple I can spring to mind who are led by one founder who's got some money, who might deploy money into small recruitment companies and bolt them on for whatever reason. Or traditionally, more institutional, where there's a group of people who have raised a fund. They take a management fee for running that fund, and then they take some of the equity uplift, called carry, as they deploy and exit it. So typically the old model is that, let's say you raise 100 million quid, you get a 2% management fee for running the fund, and then potentially 20% carried interest, which is of the proceeds that we return. We'll pick up 20% of the profits and then return the rest to our investors. And they're typically buying, historically, for circa 5 years is the life cycle of the investments. If you talk to most of the advisors at the moment, any money that was deployed in 21, 22, because of where the market's been, you're probably looking at a 7 to 8 year hold now. And so, I think if you're someone running a recruitment business, let's call it doing between let's call it between 500,000 and £2 to £3 million profit, your most likely exit at the moment is either a management buyout or a private equity backed company looking to acquire. I think fresh money coming into the sector to buy an asset, I think is going to be probably slightly tougher.
And for your own business that's gone through 2 events now, is there a PE company that backs behind you guys at the moment, and does that affect your corporate strategy and how you do things?
Yep. So first fund, which was a now listed vehicle, wasn't at the time, was Literacy Capital, and then in March 23 we closed with Three Hills Capital Partners. So bigger fund, more money, and allowed staff to take a bit more money off the table, and I guess slightly more institutional capital for us as well. How does it affect our strategy? Look, I guess given it's my second business, I always had a clear plan that I wanted to build a business that was scalable, that had equity value, and not run it as a lifestyle business, which I guess is relatively unusual. So it's not driven our strategy. What both events did was accelerate our strategy and give us more confidence that we're doing the right things, and bring a little bit more governance and support around helping execute the strategy. I think what tends to happen is that as these businesses get bigger, so you get an example, when you start your business, you take probably the most risk you're going to take. You get it up to a decent level where the founders are making a decent living, and then let's call it £1 million profit. And that's a pretty good lifestyle, right? Obviously. And then to kind of then institutionalize the business and turn it into, I guess, slightly more of a predictable machine where you're building out the infrastructure around L&D, compliance, governance, risk, finance team, marketing, where you start to be able to have a more predictable state of this is how we're going to grow the business, which is what private equity are ultimately buying, as well as you and the people. They're buying a process that requires another roll of the dice, right? So we're making £1 million profit. That's a really good lifestyle. It requires us to say, okay, how much of that £1 million profit are we willing to risk to march up the hill, and how much further can we fall down if we get it wrong? So that's another roll of the dice again, which I think gives a lot of people vertigo, and they get a bit scared of doing that. And secondly, it's usually out of their comfort zone. We go back to what we originally said around a founder being a great salesperson. You're building out all this stuff. Like, why does my finance team need to be so big? I've got to go and hire a CFO that's going to cost me 120 to 140K, and then I'm going to hire a legal person, or not just one L&D person, but 3 L&D people and 3 marketing people. And as the business gets bigger, just these are not complex businesses, but the level of complexity starts to go beyond usually the founder's knowledge. And so that's where you need some support. And so I think what private equity does, if they do come and back your business, is give you some of that support, some of that confidence. But crucially, you've also de-risked as the founder. So you take some money off the table, which allows you to roll the dice again, right? And that's a very important factor into, I guess, the thinking of usually the founder entrepreneur around what do you get out of private equity. You're getting capital, usually not to put into the business, but usually to de-risk yourself to allow you to go again.
Just a bit I'm interested in there is usually what'll happen from my experience, and you can correct me if I'm wrong. A founder will need a bit of advice, and they'll get an NED, a fractional NED on board. That NED will then shop them around to the private equity firms, almost on a beauty parade over a period once they've got them knocked into shape on certain areas. Or they may have made an introduction to a broker that will do that as an in between. Is that how it typically works, or are the private equity companies on the lookout for you and they're coming to you and they're doing that when you get to a certain stage? Or, like, I suppose a lot of people will be sub 30 listening to this, wondering what does that look like? Where do I spend my money to get to that point?
I don't think, look, if you're sub 30 people, let's say 30 people doing, I don't know, 3 million NFI, kicking out, let's call it £1 million profit, you've got the perfect sweet spot for a great lifestyle business, right? It's kind of, you can get your arms around everyone.
Yeah.
It's still usually quite fun. You're out at the point where everything's a disaster when something goes wrong. Yes, you're at quite a nice point. I don't think an NED. I don't think unless they've got a particular link to the city, they're probably not the ones to shop you around, because they might have a few introductions, a few conversations to make. But if you're genuinely going to go out to try and either exit or partially exit the business, I think you want to do that with a slightly better level of both sophistication and rigor, right? Because you can only really do this once, so you want to make sure you're doing it the right partner. So you are going to go out to an advisor, whether it's a small investment bank at that size, or one of the accounting firms who have an advisory arm. I think you need a little bit of help. What tends to put people off is the fees, right? Because the fees are, again, the spend for
Yeah.
that. What might they take? 3, 4, 500K. It feels like a lot of money. But if you're going to trade the business for, I don't know, let's call it at £1 million EBITDA, 5 million quid, it's probably money well spent. And so it's one of those things that if we get it away, you need some good advice, and then you've got lawyers on top of that, some due diligence. So, look, when we did our first deal, and again, it is our world that we recruit into, and my background, we used a small investment bank to help us. And second time round, we used a big US investment bank, right? And the fee was 7 figures. So slightly different level of rigor, but they will help prep you for sale and help prep the business. Now, like I said, I guess there's two levels. This is a more institutional deal. For those sub 30 people, I guess the chemistry's the single most important thing, more than the check, right? Because you're not going to walk out the door on day one. This is your baby, right? I always say I've got 3 kids. This is my 4th child, and I've spent way more time raising this child, sadly, than I have any of the others. And so, the chemistry with the kind of potential acquirer or partner that you're going to get into bed with is the most important thing. That's where your point around the Ned, like having
Sure.
got to know you. These are the people I think might work. In a slightly kind of less auction process, might work, right? These are 10 people I think you might want to go and speak to. Let's line up some conversations and help navigate what I guess more of a partnership deal would look like, rather than outright sale. Here are the keys. Off I walk in a year's time.
What type of stuff do they help knocking into shape?
From an advisory point of view,
Yeah, from an advisory point of view, just like how brutal is that due diligence of them coming in and the stuff that they look for? Like I'm curious, like when you're like how that world works.
the first time around for us, when we were doing 2.5 to 3 million EBITDA, first time around for us, I thought we ran a really tight ship. Like, being honest, I thought, okay, I've got this, right? I've got a financial background, not for very long, but 3 years. But I thought we ran a really tight ship. We ran stuff on spreadsheets. It was eye opening. I did the CFO job as well as the CEO job, and it was eye opening that even for a fairly small deal, the level of rigor around, okay, client analytics, concentration of clients, concentration of billing, hiring people, time to get them up to speed, etc., was still something we were not used to. Second time round, it was a full-time job for about 4 of us, plus we brought an outside resource, plus we hired other people to help with it, because the level of financial analysis, as well as commercial analysis and legal analysis, it was a 9-month process. It was a really lengthy process. So we needed some support around it. And again, you go into these things thinking this is a very simple business, it's a really tidy business, but one of the things, like, the more data you can provide, the more data you're going to get asked for. I think that first time round, 30-person business, what you need to be able to articulate, probably 3 things. 1, this is the business, this is the market opportunity, this is what we do well, and this is what we want to go and do in the future. 2, probably our core commercial sales process outside the market. How do we hire, deploy, train, deploy, and get these people out to go and make us money and keep them? And what does that career path look like? And then 3, there's all going to be the background DD in terms of legal DD around your client stickiness, customer concentration, geographies, how predictable are your financials? Obviously, what you'd like to be able to show is, we started the business, there was one of us. Year one, there were five of us. We went from 5 to 10 to 15 to 25. And the story is one of, it's a hockey stick and it's just getting faster. We're getting better at running this business and our profits have gone up in line with that. I think, again, being candid, it's going to hold people back in the last couple of years. No one wants to buy a business that just follows the market. And it's like, oh yeah, when it was 21 and 22, we got to 35 people and we were making £1.5 million profit. And then actually in 23 and 24, we got smashed to pieces and it's dropped down to 250K. It's just too volatile. So you've got to show an ability to weather the storm, or at least beat the market rather than just track the market. And that I think is one of the single biggest challenges in the last 18 months of years, is how much better the market versus just following the market.
And just in terms of getting that valuation, people have it in their heads that it's worth something. It's like the Antiques Roadshow, really. You see them all disappointed when they actually get told how much it's worth.
Yeah.
Um,
apart from the person who's gone and checked, oh really? It's worth
Yeah.
3 million quid? Wow. That old watch.
they don't exist in agency.
I love that.
Yeah.
Yeah.
What's the story? Temp and perm and RPOs and like consult versus having consultancy in there. Like what are the things that like you found that if you could do it again, you would have maybe focused on slightly differently, or that, yeah, just give us an insight into that valuation process, please.
I think look, what people want is predictable, steady revenue, right? So whether that predictable revenue in terms of perm or interim or contract or RPO, an investor coming into the business, and we're going, I guess, into the level of, again, institutional investments. These guys are not operators generally, right? They've never run a recruitment company. They might have a view on recruitment because they've used recruiters, but they've never sat on a sales floor, or it's unlikely to sat on a sales floor. So you've got to educate them around, this is the business and this is what we do and this is how we make money. And the uncertainty that you've got, there's for good reason, right? Particularly in the last couple of years, there is a view on the recruitment businesses which, A, they view like the Wild West. B, they follow the market. Very hard to have some predictability in these smaller businesses. And so C, it's just going to undulate. What attracts people to the market is the market size, right? You look at the billions spent globally on recruitment and ancillary services. You look at it and go, well, there must be a play there to kind of grab more of the market share. And look, candidly, the bigger businesses have done that, right? So Hayes, Michael Page, Robert Walters, S3, to name, I guess, the bigger listed ones, over their share prices have all dropped between 20 and 45% in the last year. I think S3's dropped 25% in one day, back end of last year. Wow. But you look at their accounts, right, and they are generally chucking out really good profit year after year after year. Now, it might have dropped off a cliff in the last couple of years, but they've got a pretty good moat around their business. And so as a play on the market cycle, will they recover? And can they gear up faster than a small business? Yes, right. And I look at us and say, look, we're at kind of circa, I don't know, 50, 60 million quid NFI. There's a huge amount of market opportunity for all smaller businesses to go and eat into market share, regardless of the wider market. It's like Hungry Hippos is the example I was using, right? Hungry Hippos for me is you play to eat all the marbles, right? Take all the marbles off the table. That's winning. And even when the market's contracting and there are fewer marbles there, let's gobble into that market share. And if you have that attitude, when the market picks up, we just own more of the market when we come out of it. And so I guess your original question is around what are we selling? I think you're trying to sell something that shows that you've got a process that allows you to keep growing, almost come rain or shine, right? Not obviously if a GFC happens or a 9/11 happens the whole world contracts, but how do you beat the market? And I think the better businesses that have done that, I guess, in our time, that you see them get backed, something like a Faden, right, is they've got a great sales culture that just allows them to keep going and keep going. Now, obviously, people go, "Oh, Faden, I wouldn't want to work there." It's not going
I've
to be
been on the shop floor in New York. It's amazing.
exactly. It's not.
And without speaking out of turn on others, I've been in quite a few in New York. And Faden, I went into Faden. I was like, oh wow, this shit's alive in here. Right?
Yeah.
And I met the head guy, and he was fucking wrecked. He looked like he'd been working 20 days straight with no sleep. And it was just loads of people just fired up. And I was like, wow, these guys are going for it. Like it was, I could feel it the second I walked in the room,
Yeah.
you know.
Yeah. Look, I think that it's a machine, and they built it as a machine, and it's grown steadily and predictably. Right. Obviously, again, it came off the boil in the last 18 months because they were exposed to one market, but they've got a very clear culture. They know who they are, and they won't back down from that. And they've got a great process. Um, a lot of us recoil, going, "Oh, I wouldn't want to work there." Yeah, but you'd love to
For
own it,
sure.
wouldn't you? You'd love to own
Yeah,
it.
I'd love to own it. You know.
Yeah.
Yeah, they're always the great example. But just if I could go into the minutia of that question, it's just, is there like a formulaic process on getting that multiple? So like, I don't know what Faden's was, but it was famously they got the best multiple, and nobody's achieved a multiple like it since. And from what I hear, private equity has slightly changed since that, without knowing too much detail on the subject. What what is it like? Do you need 50% of your business to be contract, or is there another way? No, because I would think you're more a perm heavy business. Is that right?
We're a perm heavy business, and
Yeah.
Faden broke the mold, right? They're a perm, it's almost entirely perm business.
Yeah.
And I think I could be wrong on this, but I think second time round post I think they had a debt provider initially to do their first deal, and the first proper private equity deal, I think they went for about 10x, and I think last time round they went for about 8x, but on a um, much bigger EBITDA. I think their EBITDA was heading towards 100 million. So I think it was like 95 million. And the multiple came off a bit, but obviously the size of the deal's bigger. Look, received wisdom in the industry is that for an interim business, you're going to get a notch, one turn higher. I go back to, I think you're looking for predictability of revenue. So actually, it's not necessarily what's Baden were great at. It was like this revenue's predictable, whether it's perm or not. We can hire grads and turn them into killer salespeople. And we've got a predictable formula around that. I think we've got our version of that, which has been we've predictably grown, over the years. So look, I think a lot of it comes down to the size of the business actually, and the kind of steadiness of the business. So
Mm.
I think anything that's kind of doing 3 million profit, and I guess just to be clear, we talk about EBITDA, you've got to bake back in, the two founders billing most of the money or only most of the ratio. It's like you've got to discount all of that. So 3 million proper profit, you're paying your senior guys a market rate, you've got the infrastructure, you're not putting a ton of kind of one-offs or add backs back into the numbers. In a perm business in the UK today, you're probably getting 4 to 5x on that business. But look, the multiple's only one thing, right? The deal structure is the bit that, again, people just don't think about. So let's say you're making £3 million profit today, and you're 50 years old, and someone offers you 4x for the business, and you go, well, I want more than that. That 4x could be 12 million quid, check today. Here's 12 million quid today, do a 6-month handover and walk out the door, right? Someone could offer you 6x for the business, 18 million quid, and say, okay, but I'm going to pay you 6 million today, 6 million in 2 years' time, and 6 million for hitting a certain set of numbers, which be your earn out, and depending on your risk appetite, or your age
Yeah.
demographic, or how you feel like you want to be accountable to someone else suddenly, having run your business, do you take the smaller check upfront day one, or do you take a structured deal and say, actually, I want to buy at the 18 million quid, right? And we look at businesses that are sometimes doing, I don't know, 1-2 million EBITDA, but we look at the kind of founders of a business and they're, I don't know, let's say in their 30s, and we go, we will de-risk you today, but we want you in the business for the next 10 years. We think the future's much brighter than today, and we're buying you to help grow your business, right? And we want you on board. Equally, we might look at a business that's been around for, I don't know, call it 20 years, and say, actually, you've kind of taken it as far as you're going to take it. We really like the brand, and you're in a sector that we can't build or don't want to build ourselves. You get us in there, but we'll take it from here, and we'll bring in our own management team.
Before you set up Dartmouth, you were in executive search, and when you acquire businesses now, do you look for small executive search firms to come into the fold? Is that because they find it very hard to scale, as we discussed the last time that you were on? Is that part of the corporate strategy that you have?
Yeah, I wasn't in search. So I before Dartmouth, I ran a business called Cornell, which I started in 2005 with only 1 year's contingent recruitment experience, and that was done in a good way, but it wasn't out and out search.
Yeah.
And so, look, the kind of businesses we want to buy, we have two views on it. One is a platform business, which we think is of a certain scale, so probably north of 50, 60 heads, probably north of 2 million EBITDA, and growing, and that takes us into a new market, right? So Pure was like that. Or we have what we view as a bolt-on, which is probably anything from 3 up to 25 heads in a market that we currently operate in, but we're underweight in, and we can say we can bolt you into one of the brands, and we'd probably end up having some transition away from having a dual brand and merging it with something that makes sense. But look, both routes give the founders or the people running the business, I guess, some support infrastructure to help accelerate their own plan. It's not just an exit. And I think that the one thing that, when we talk about exits and going right to the beginning, I'll sell the business. Selling the business is usually not you walking out the door as quickly as you think you are, right? Because
here you are.
Yeah. But look, I wanted to stay on, right? And I plan to, if people want me around and I feel like I've still got the energy to keep going, I'll keep going. I still enjoy the job, and I still think that, I said this openly, I think we're getting better at running the business as a management team. I think we're just finding our stride after 10 years. We're slow learners. Also, we're just getting it.
But your game's evolved, because not like from the last time we spoke to now, obviously you've had more event. There's more liquidity. There's more different markets. There's been purchasing other businesses. So for you, playing that computer game, pulling strings, like, your day's different than it was 3 years ago. So that keeps your mind occupied and keeps the game moving forward, which was part of it at this stage.
Absolutely. Yeah. Look, I'm not just a cold caller. Just it's changed. I actually did. Funny enough, I did a couple of headhunt courses before this, because I'm working a very serious search. But look, the job changes and evolves, like, for better or worse. And again, you've got to be okay with that. Again, typically, sales leaders love walking the sales floor, right? They love walking the sales floor. They want to be out there at every lunch club, down the pub with the troops. If that's what you want to be, you're going to probably need to hire a CEO at some point, right? And that's you've got to accept that it's a different job. The job evolves, and you've got to embrace that. A bit like, if you get into bed with private equity, being answerable to a third party is what you're signing up for. And I guess you hear this better than I do, but so many people will take someone's money and then be surprised about the questions you're being asked. It's like, well, I run the business. Like, well, but you don't own the business, Charlie. Like, you've got a contractual obligation, and probably a moral obligation, to deliver on the plan that you outlined when you're running the process. And that's where, I think, again, our sector, a lot of folk, they just don't, they're self-employed because they want to be accountable to anyone. I know, I'm sick of being answerable to KPIs or deliverables, or being asked what my fee pipeline is this week or this month. I'm going to run it myself. That's, that actually then permeates into how they run the business, and that's fine. You just, don't take someone else's money then.
And Logan, just to kind of ask you a final question or a final topic to go through. You mentioned that the next cycle is probably 2020. Was it
20,
2028?
2028 is what we're aiming for, yeah. 28,
Yeah.
29.
Which I'm sure a lot of people are in that. They almost sold after you're lucky you got that deal through, right? Because
We were lucky.
because the market out there went, the money left, loads of deals fell over, like it was, and there was loads of people who were so close, and some people made it and some people didn't.
Yeah.
So on the next cycle, with the event of and the relentless march of technology and automation and the way things are working, like, are people still going to want to buy recruitment firms at that stage? Is the world, do you see the world changing that quickly? Do you do you how do you see the future of recruitment in the next 10 years?
I mean, look, if I knew that, I wouldn't be doing this. I'd be trading something, wouldn't I? I think that, look, I'll use the words of my chair, because our chair built a business that went from scratch to being sold for 550 million quid in our sector. It's unusual, and it's
Who's
probably
that?
Richard Macmillan. So built ICS, now called Acacium. And so, look, when we said to him, look, what's the market going to look like in 4 or 5 years' time? His view was like, don't worry about that. Worry about building a premium, good business, do all the right things. In 5 years' time, there's always going to be a buyer for a good asset. So build an asset that stands out, and you'll be fine. And I think that's probably
Brilliant.
the best advice you can give to anyone, right? Don't just do something for the endpoint. Do it, like, do all the right things, and you'll find that your house is built on firm foundations.
Fantastic. Look, great chatting to you. Thanks so much. I took a lot from this. Really, really, really good interview. And yeah, I've nothing left to ask you. You've covered it all.
Nice to see you, mate. Pleasure.
All right. Take care, pal.
Cheers. Thanks, Walter.